Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Caterpillar Incorporated, ticker CAT. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. Let's dive on in. First up, we see that the market cap is $109 billion, EV at $128 billion. We can presume then they have a decent amount of debt, putting some leverage on this business. They operate in the machinery industry. Caterpillars tend to run construction and mining equipment, diesel, natural gas engines, industrial gas turbines worldwide. Gives you some idea they're in the construction industry, and they are producing a lot of those pieces. They also seem to have a financial product segment that offers operating and financial leases. That's useful information. So they have a beta 0.92, share turnover 142%. So the first thing that immediately jumps out when you look at this return on invested capital chart is the cyclicality. It's inevitable to see that this company is very, very cyclical. You have clear cycles, up, down, up, down, up, down. So you see that that they had basically a bottom of a cycle in 2002, top in 2006, bottom in 2009, top in 2011, bottom in 2016, top in 2018. So every, 3 to 5 years, these are maybe 7-year cycles, maybe about a 7-year cycle is about average 5 to 7 years. You're seeing this cyclicality. And so at the bottom of the cycles, for the most part, they're still earning money. That's a positive sign. Some cyclical companies will dip into losses during the bottom of a cycle, and you do see that they lost money in 2016. But even in 2009, they did make a profit. So you like the fact that even in a cyclical company, they only have 1 year of losses in the last 20 years. That's a positive sign for its business quality. However, I would say that the biggest thing that you get out of this is that this is an average company. This is not a high quality company. Well, why? Because the negative is that it's one, cyclical. The more cyclical you are, the lower quality the business is. 2, they do have a single year where they lost money, but that's not a major concern. But 3, that their best performance, the return on invested capital, is capping out at about 10%, 11%, 12%. But you have a lot of years where you're spending it in this 5 to 10% range is probably the average. And when we see here, we see the 10-year median return on invested capital is 6%. That's not very high. You would like a number higher than that. You want this to be a double-digit number. If the bottom here was 10%, then it completely changes the story, because it would mean that now you're averaging 10 to 20% returns instead of 2 to 10% returns. And that's a huge difference in the overall performance an investor can expect. And so that's my first gut, is this is just an average company. Now, then when we go over here and we look at the valuation, you see a PE of 16.9. That's an average price. An average companies trade at an average price about PE of 15. 17, 15 is very, very similar. So it's maybe trading even a slightly above average for an average company, which is not great. So potentially this company is, fair value to slightly overvalued. You'd like to buy something like this below a PE of 15, because 15 is what marks an average company for historical periods. And so that's what I'm seeing. Now, you do see return on equity here of 19%. It means that leverage that I mentioned here, that the debt that they have on this business is allowing them to earn higher returns. However, the problem is you see revenue declining over the course of the decade, minus 1.6%. Assets are flat, but revenue is declining. Free cash flow is declining. EPS is declining. Or EPS is growing. Maybe there's buybacks here or something along those lines. But basically, their revenue is declining. They started the decade with $65 billion in revenue. They end the decade with $50 billion in revenue. And they were never close to $65 billion after 2012. In 2013, they had $55 billion, and they still didn't get back to that. So my concern here is I'm looking, okay, I have $50 billion in revenue today. What is my revenue going to be in 10 years? Is it going to be 40 billion? Is it going to be 30 billion? And you basically lost, 20 to 30% of your revenue over the course of the decade. Why couldn't you lose another 20 to 30%? And so that's a really bad position, which means if your company's declining, you can't justify a PE of 16 or 17. You need to have a PE of like 8 or below. So I would reassess here and say this company is actually overvalued at a PE of 17 because their revenue is declining. Now, if they could be growing revenue, that would change my assessment of the business. And part of the problem you see is that Their revenues aren't stably growing or declining. It's not like it's 0% every year, so it's predictable. Instead, it's like 10% up, 15% down, 1% down, 15% down, 18% down, 18% up. It's all over the place. And then your gross margins are also fluctuating. Stable gross margins indicate a higher quality company, but you're going from 27% to 25%, to 27%, to 25%, 29%, 31%, all over the place. The company doesn't have stable margins, so they're not able to set prices based upon their costs. They're not able to pass costs on to customers. So this actually would indicate more of a lower quality business. So this business is likely lower to average quality, and the price is relatively high. If you're enjoying this video so far, please hit that like button. Don't forget to subscribe. I'm working through every company in S&P 500. 5 videos a week, working through getting these videos out for you on different companies in the S&P 500. If you're enjoying that, you need to subscribe. You need to ring that bell so you can get notifications as I upload new videos each and every week. So here we can look at the income statement. Now, one of the things that's interesting is that despite having their revenue go down by $15 billion, gross profit has only declined by $3 billion. So you see this $65 billion to $50 billion. They lost $15 billion in revenue, but because of probably changes in mix or changes in their costs, they've been able to manage that to only a $3 billion loss in gross profit. That's actually a really, really good sign. Indicates that management is managing that very well. They're also pulling SG&A out of the business. They're reducing their expenses here. They're reducing their R&D expenses. This is how they're managing to stem the tide. So again, you lost a huge amount of $3 billion in gross profit, but they avoided having to lose more. They actually had less than $3 billion lost in operating profit. So again, well managed in that decline. This company could be doing much, much worse. It also shows through that management, although you have some non-operating income, that's going to mess up my analysis here. But they're buying back shares. So despite declining, they're having less shares, which is allowing this EPS to be higher at the end of the decade. Though again, that's covered up by the fact that you had some non-operating income here, so it makes it a tougher analysis. But basically, the declining share count is allowing you to have a little bit more stability in that bottom line number. But overall, they seem to be managing their income statement well. Now, on the balance sheet side of things, we can see that they're also pulling some assets out of the business. You had $14 billion in PP&E at the beginning, $12 billion in PPE at the end, $14.5 billion in inventory, $14 billion in inventory, receivables $17 billion, $17 billion. So they're really working hard to manage their balance sheet, but it's not going down at the rate of revenues, which is a concern, and it does mean that you're going to have likely have lower returns over time. You have a lot of debt on this business, $25 billion in debt against that $12 billion in PP&E plus $14 billion in inventory. So basically your debt's matching your inventory or plus your PP&E, but pretty high amounts of debt, and you really need that so that shareholders get anything. And if prices of that debt increase due to changes in interest rates, that could be really devastating for the company. Now, they don't have stock-based compensation on this cash flow statement. I really like seeing that. There's no reason you would need it. The buybacks aren't stable, but they are happening almost every year, so that's good. You can see a lot of debt issuance, positive cash flow from operations every year, despite having losses in one of those years. Which year did we have a loss? 2016? So let's see our cash flow from operations. You still had $5.6 billion in cash flow from operations in that year, and I'm guessing you had a negative other operating income that affected this. You can see these large net interest incomes. They're paying a lot of interest, $500 million. So they basically paid $500 million in interest on $24 billion in debt. If that debt were to rise in cost, that's going to be a major, major concern, and you could just basically start wiping out a lot of the net income. So for me, I would avoid this company. I don't buy into cyclical companies. It's also very, very expensive for the future revenue that you're having. Basically, returns on equity being in 20% doesn't matter unless you're growing, and since you're not growing, those numbers are basically meaningless. So I would not consider this company unless the PE minus the revenue growth, and since this is negative, is at least 10%. So if you're going to have 2% loss, declining revenue, then you need to be 2% below a 10 PE. So you need to be at least like an 8 PE or something, 7 PE before I'd consider something like this. And even then, I'm not interested because of the cyclicality. It's really hard for me to predict the future of this business. So I would pass on Caterpillar. If you enjoyed this, if you learned something, please hit that like button. Please subscribe. Your subscriptions let you know when I upload new investing videos, new companies each and every week. Come along for the ride as I work through the entire S&P 500. Thank you for listening, and until next time, stop paying fees, start building wealth.